Good Monday morning, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Titans diverge on tech as Peter Thiel bails out on Nvidia, but Warren Buffett bets billions on Google.
And awash in garbage lending, Jeffrey Gundlach warns that private credit is the next subprime.
And the Swiss miss. UBS may ditch Switzerland as its chairman mulls a move to the United States of America.
Meanwhile, Matt, you mentioned it, Berkshire Hathaway having some impact on stocks this morning after reporting 13 Fs for them. It is a new Alphabet holding. Those shares surging, well, not surging, I guess 3.3% is a surge, I don't know. Warren Buffett, Berkshire Hathaway, buying nearly 18 million shares of Alphabet in the third quarter. I believe that's worth about $4.9 billion.
Well, they've added a ton more than that to Google's market share. It counts as a surge if you're a $3 trillion company. Nvidia, a $5 trillion company, or once was, now down 1.33%. We have more signs that big masters of the universe, now Peter Thiel, are selling out their stakes. In the 13Fs, his hedge fund dumped all of its Nvidia just days after news that SoftBank sold its entire stake, a sign that tech insiders are taking profits at these valuations.
And Matt, adding to that, one of Wall Street's bond kings is spotting overpriced assets almost everywhere he looks. DoubleLine Capital founder Jeffrey Gundlach told the Odd Lots podcast as part of their 10-year anniversary that this has been an unprecedented bull run.
The health of the equity market in the United States it's among the least healthy in my entire career in terms of the PE ratio, the CAPE ratio, all the classic valuation metrics are off the charts.
And Bloomberg Tech co-host Caroline Hyde joins us now to discuss big tech players selling their stakes in Nvidia. Caroline, it just feels like this constant buildup of people being more willing to be vocal about their bearishness on stocks like Nvidia.
Drip, drip, drip. This one is a filing, 13 Fs, and so we get it just by osmosis of the fact that they had to say, and this is the macro fund that Peter Thiel has set up. This is bet on public equities that he's out of Nvidia. Now, not nearly to the tune of $5.8 billion worth, as we saw with SoftBank. This is only $100 million worth. But still, the fact that they pull back entirely and get rid of a US energy company, Vista as well, they're still in Tesla, which has AI exposure, and that's the #1 holding now. They're still in Apple. They're still in Microsoft, which has a lot of AI exposure. And you've got to remember, Peter Thiel is making other bets in his private equity side of the house, the VC side of the house. He's making bets on the new forms of how you create and manufacture chips with substrate. He's been backing Cognition AI, which is another LLM, which is the company that's helping you really, whether it's agentic help when they're coding. These are bets still on artificial intelligence more broadly. So is he taking profit like we saw with SoftBank? Because remember, SoftBank got out entirely, but again was redeploying that in OpenAI and other areas of artificial intelligence. Is it that NVIDIA's just done too well? Or is there something more that they're trying to signal here in terms of whether the money's going to keep going its direction for GPUs?
But it's just one more of these incredibly well-respected investors, right?
Yeah.
You have Michael Burry shorting it to the point where he's even closed down his hedge fund, maybe so he can hit it even harder. You have Peter Thiel selling his entire stake in Nvidia. You have SoftBank selling its entire stake in Nvidia. And you have Jeff Gundlach saying these valuations are incredibly high no matter how you look at them.
And what's interesting about Jeffrey Gundlach was that he doesn't really know how to play it elsewhere other than put it into cash. He's not saying get into gold anymore. It's really trying to understand how you bet against what you get the feeling of an AI bubble. Are you just trying to cut out some of your winners? Because, look, people are still out there raising money to put more money into the data center play. Look what Amazon's doing today. It's following on from Alphabet, another 6-part bond sale. This one's going to be the first time it's tapped the US debt market in 3 years. They're trying to basically have to raise money in all different variations, making the most of pretty cheap debt if you're looking at 40-year just
all of these mega cap tech companies are taking on more and more debt and buying more and more fixed assets.
Yeah.
What is happening?
But they got so much money. And maybe it's just starting to trying to be savvy with the way in which you spend. Is it just using your cash deployment? Is it therefore being able to use your cash to buy back shares or indeed buy other companies and meanwhile go to the debt markets, which at the moment paying just a percentage point over 40-year US Treasury. I mean, it's just extraordinary how cheap we could do that. But they've got a whole load of capital expenditure to keep on deploying, and that's what we're going to see in the fundamentals on Wednesday. Nvidia, we get their earnings, and we're going to actually see how much money is coming, the wall of cash coming their direction. Is everyone going to wish they actually didn't sell out?
Yeah. Levi Strauss, I'm looking at headlines right now. Levi Strauss is getting into AI with Microsoft.
Yeah, of course.
I mean,
of course it has to.
Yeah, well.
So you want AI genes?
Yeah, exactly.
But then does like Levi become an AI play, and then all of a sudden, if the AI play crumbles, do you have to worry about like your Levi Strauss stock starting to fall? It's this weird like interconnected weave we are.
This is how it happens.
But or is this just like the .com? You know, you can get a website. We'll just stop talking about AI at some point because every company will have intertwined it for productivity's sake.
Right. This is like if a pet store decided to become .com. All right, Caroline Hyde.
Never heard of it.
Caroline Hyde co-anchors Bloomberg Tech that kicks off at 11 a.m. today. A lot going on in that world, as usual. As Dani mentioned at the top of the show, Google is up after Warren Buffett's Berkshire Hathaway bought nearly 18 million shares of Alphabet in the third quarter. Bloomberg Intelligence senior analyst Matthew Palazzola, who covers all things Warren Buffett, joins us now. So, Matt, Buffett has said he was late to this trade. Is this how he makes up for it?
Maybe. I mean, he may not have even made this trade, to be honest. He is on his way out. He's stepping down as CEO at the end of the year. He has two investment deputies, Ted and Todd, and they have relatively low profiles. Why I didn't say their names, but
Ted and Todd.
Ted and Todd.
Sounds like a couple of guys at the squash club.
Exactly.
You know?
And so there are talks that they manage maybe like 10 billion each. Or a certain percentage of the portfolio. He doesn't. Every once in a while, he'll attribute trades to them. The thought is they are kind of more tech-savvy investors, where Buffett has admitted not really fully understanding Google in the past. So Buffett may not have even made the trade.
They also increased their position in a fellow insurer, in Chubb. Is there something behind that that could maybe lead to takeover speculation?
Is there something brewing there?
Exactly.
So, there might be speculation. Look, Chubb, I think we cover Chubb. It is a global insurer, one of the best in the world. Great margins, great growth, great management. I see it being pretty tough for the management of Chubb to want to be absorbed, though I could see Evan Greenberg, the CEO of Chubb, being enticed by running that Berkshire Hathaway insurance empire.
What's your take on Warren Buffett going quiet? I mean, you've been following this company for years. You go to the meetings. Is it in your mind, is it a problem for Berkshire, or has he set them up so well that they can continue on?
So I think he's been setting them up. He's been every year I'm there, he's kind of a little slower. He's talked about how he stepped back from daily duties. He hands things over to Greg Abel. So he's been prepping for a long time. They have mountains of cash. I do think.
Is that a good thing, Matt?
So it's not necessarily a good thing.
Way too much cash?
I mean, having mountains of cash, I guess, is always a good problem.
Right,
but I think there is the school of thought that they lose a bit of the magic, and they are going to not be as good as they were in a lot of
There's an
aspects.
opportunity cost to holding cash, right? It's not always a great thing, unless you're Jeffrey Gundlach and worried that the sky is caving in.
I still wouldn't mind. I agree with Matt. It's not really a horrible thing having over $300 billion.
Perhaps, fair enough. Matt, thank you so much for joining us this morning. Matthew Palazzola of our Bloomberg Intelligence team. Now, breaking news in the past 8 minutes, Ford striking a deal with Amazon to offer used cars on the e-commerce site. Joining us now is Bloomberg auto reporter Keith Naughton. Keith, I was just looking at the Ford share price. It initially pops on this, and then you can see it's still down. So is this a game changer for Ford at all to be able to sell its used vehicles on Amazon?
It's sort of Ford putting a toe in the water on doing a deal with Amazon. Hyundai was the first to get on the Amazon Autos portal about a year ago, and they're selling new cars. Ford is coming with its certified used cars first to see how that goes. They are getting a lot of interest from their dealers in it. They do this in partnership with their dealers, but it will sort of address these issues that consumers have about the hassles of buying a car. It's, one fixed price. It's a pretty speedy process. You can do it all, on your phone or at your laptop.
Can't do any deals though, right? With Amazon, I like buying a car because you get to really move the price down if you know how to do it. It's interesting that it's just used cars because, on the one hand, they're not going with the new cars like Hyundai and others who have gone online in various forms. On the other hand, it says something about the affordability of new cars that people are taking certified used cars as a real substitute.
That's absolutely right, Matt. We have this affordability crisis in the new car market where the average price is now over $50,000. Well, the average price of a used car, a 3-year-old used car, is about $31,000, which I know sounds like what a new car used to be. It is, but it's still more affordable. So many new car buyers are migrating to the used lot. Ford's certified program, like many other certified programs, includes a multi-point inspection. You actually can get a warranty of up to a year and 12,000 miles. So it's feeling a little more like the new car buying experience. There's a few more guarantees, but it is a growing market. Used vehicles are what a lot of mainstream buyers are turning to.
All right, Keith, I just want to quickly ask also about the Lightning, because I was on Ford's website this morning putting together my dream Tremor. Is the F-150 Lightning no longer going to be built? Is it done?
Well, what sources are saying is that they're considering dropping the Lightning. Absolutely. It's not selling very well, Matt, and it's paused at the moment as follow-up to that supplier fire they had in September. They're putting all their efforts into building regular gas-powered and hybrid F-150s, which actually make them money, whereas the Lightning loses them gobs and gobs of money.
Keith, thank you very much for that. That's Bloomberg's Keith Naughton out of Detroit. A quick check on futures this morning, because what started out with a gain in the futures session has turned into losses. Seems to have coincided with that monster debt offering from Amazon putting pressure on treasuries. We're down about 0.2 across the board for both the S&P and NASDAQ after just barely getting out gains for last week. Russell 2000 futures, those underperform, Matt. They are down 1/3%.
Let's get a look at some of the other movers on our radar this morning. Crypto-linked stocks broadly are down, although you can see Circle, the stablecoin issuer, is up as Bitcoin trades flat for the year. So we've lost everything we've gained and then some. We did see some of these crypto stocks a little bit higher, but they've turned negative.
And alongside those declines, Dell and HP, they're also falling. This is after a Morgan Stanley cut. They said that some of these hardware stocks are at risk from a memory supercycle downside.
Johnson & Johnson is buying Halda Therapeutics for $3 billion on this M&A Monday to bolster its offerings to treat prostate cancer. And I'm sure we'll have more deals floating in throughout the morning.
I'm sure we will on this M&A Monday, Matt. Okay, coming up, how about this for a deal? The chairman of UBS and Treasury Secretary Scott Bessent have reportedly discussed moving the bank's headquarters to the U.S. We're going to have those details coming up next.
Let's get to high interest. Look what's making headlines around the world. European officials are warning Washington not to undercut their new trade deal. The EU says a U.S. push to expand the list of products facing higher steel and aluminum tariffs could breach the spirit of the summer agreement that capped most duties at 15%. Brussels plans to raise the issue with Commerce Secretary Howard Lutnick and Trade Representative Jamieson Greer next week. But be warned, guys. DoubleLine Capital founder Jeff Gundlach is raising alarms over private credit.
In recent years, the garbage lending has not gone to the public markets. The garbage lending has gone to these private markets. And private credit has been very popular and is now increasingly been over-allocated to by large asset pools.
Gundlach tells us we should be holding 20% in cash to avoid private credit, calling it the next subprime. We'll be talking a lot about that throughout the program. And trading the Alps for Uncle Sam. UBS Chairman Colm Kelleher has held private talks with Treasury Secretary Scott Bessent about moving the bank's headquarters to America. That's according to the Financial Times. The Trump administration is said to be receptive as Switzerland pushes ahead with tougher capital rules that could cost UBS $26 billion in a way. It wouldn't really cost them that, but we're going to explain. A relocation would let the world's biggest wealth manager tap looser U.S. regulations and deepen its ambitions to buy a U.S. wealth firm. Dani, how on earth did these private talks become part of the news? Was it leaked, perhaps?
It just might have been. And I think the FT might be behind that. And I wonder why it would be leaked. Let's get more on this story. Bloomberg chief Wall Street correspondent Sridhar Natarajan joins us now. I mean, Sri, is this anything other than UBS sending a big old signal to Swiss regulators?
Look, that is the cynical perspective here. That is the thing that we should look at. And that's probably true. It is a pressure campaign. But the drumbeat of the relocation threat has been growing louder through the course of the year. This is not the first that we've heard of it. This is the first that we've heard of a senior U.S. government official named in such a conversation, the Treasury Secretary Scott Bessent. But over the course of the last year, we've been talking about this because UBS has been very clear that if Switzerland goes ahead with these new capital requirements, they will have to hold an extra $26 billion in capital, and that they believe will certainly make them uncompetitive internationally. Their capital requirements will go from anywhere from somewhere in the 14% region to 20% region, and they believe that is too punitive.
I mean, come on. The top income tax rate in Switzerland is 15%. Those bankers are going to give that up for what, 35% here? Sounds like it's never going to happen.
Look, I think it's fair to say it's highly unlikely because you can't even ignore the significance of such a move. UBS is the Union Bank of Switzerland, goes back to 1862. It's synonymous with the expansion, the industrial expansion of Switzerland over the last century and a half. And what modern-day Switzerland today has been financed with banks like UBS and Credit Suisse. And UBS and Credit Suisse today are one bank, UBS. So if such a move were to happen, it would be dramatic. It would have a big impact on Switzerland because, don't forget, the crown jewel of Switzerland is their tourism economy and their banking system. So if you have their last remaining global bank leave the country, that will certainly dent their reputation. So if you were to handicap this, I would still take the under than the over on UBS moving out of Switzerland. But you can't ignore the threat at this moment.
I would say, to your point, if it's like the last big bank, isn't this to some degree a problem of Switzerland's own making? The fact that it initiated this forced marriage between Credit Suisse and UBS means that UBS has so much more punching power than perhaps it would have in the past.
Yes, but you also have to remember why Switzerland had to step in the first place. A government does not desire to orchestrate a merger like the UBS and CS merger that we saw in 2023. Credit Suisse was in real trouble. And remember, back in 2008, the Swiss government did inject some 6 billion francs in the UBS balance sheet to help UBS through the global financial crisis. So the government will say, when times have gotten dire, we've had to get involved. And that is why it makes sense for us to actually make the system more sound, make the capital requirements a little more harsh for the banks so that we don't have to come to a situation like this every 10 to 15 years.
I wonder where they would go. I mean, you know, West Palm Beach, I guess, is one possibility, or Miami. Colorado, you know, because the Rockies, you can't ski in New York. Do you think they would be here in New York City?
The only thing I want to say is I'm glad we're not throwing out the options you were discussing before we got on air about the possible new names for UBS. I think they should just stick with UBS wherever they are.
Obviously, you just choose what has the best name, and that's where you relocate.
I thought UBUS had a good ring to it. No?
No.
UBE, the Union Bank of Earth.
I'm so glad you're not in strategy consulting.
Sri, great having you on the program. Thanks so much for joining us. Bloomberg Chief Washington Correspondent, Chief Wall Street Correspondent, Sri Natarajan. Coming up, the S&P 500 at 7,900. That's Infrastructure Capital CEO Jay Hatfield's target for 2026. He joins us next to talk about that. This is Bloomberg Open Interest.
I think in equities today, investors should have maximum 40%. If you're at 40% in stocks and 20% or 25% in bonds, you've got another 35, 40% to allocate. And I've been very, very bullish on gold. The rest, I think I would be in cash because I think valuations are just incredibly high.
Double Line's Jeffrey Gundlach on the Odd Lots podcast warning about high valuations, saying hold 20% cash. Joining us now is Infrastructure Capital CEO and Portfolio Manager Jay Hatfield. He has a 7,000 target for the S&P 500 in 2025 and a 7,900 target for 2026. Jay, I'd assume that you disagree with Mr. Gundlach on this idea that you should be holding 20% cash in today's environment.
Yes, we think you should be holding 0% cash in this environment. So we're bulled up. You should always really be long when the Fed's cutting rates. Maybe this Fed won't cut rates, but we're confident the next Fed with a new Fed chair will. And you have the AI boom, so it's pretty obvious you should be long. And we think when you're coming out of the cycle, you shouldn't be so concerned about credit.
we've started getting a lot more layoff announcements or speculation. Is that, you think, going to continue? Will the Fed have to cut rates deeper into 2026? Or will inflation become more of a problem than it already is? And I would submit that at 3%, after what we've already had, it is a problem.
Well, we don't agree with that. So we adjust CPI for shelter. We use real-time shelter. So PCE-R, you can get that on our website. You're welcome to license it, by the way. We don't charge for it. Is 2% already. CPI-R, so using the internet and real-time data, is 1.3%. Money supply is shrinking at 6%. So we think there's a chance we'll have actual deflation if it was properly measured.
Money supply is shrinking. What do you look at for
we
money
look at
supply?
M0. So
okay, I was looking at M2, and it seems to be coming back up.
That gets distorted now, and it's kind of irrelevant now because the Fed can't restrict reserves anymore. There's no limit on reserves. And it's better to look at M0. It comes out every Thursday. The Fed publishes it. And that's what the Fed controls, and that's what also drives Fed funds.
Jay, really quickly, because we only have a minute until we need to leave for the opening bell, but we're about to get a pretty massive amount of tax savings, tax refunds, maybe tariff relief. Is that factored into this market yet?
I think that's a tailwind for the market for sure. We don't think that's inflationary. It's really money supply that's inflationary. So, but that will be good for next year. We're projecting 3% growth next year, partly for those reasons, but also if the Fed cuts, then the housing market should improve. And that's really what's causing lower employment, is a declining housing market.
All right, Jay, you're going to stay with us. We have the opening bell coming up soon. And a quick check on futures before we get that, just under 4 minutes to go until the opening bell. And it's been a tough start. Over the past 30 minutes, we saw futures go negative after that monster bond offering from Amazon, down 1/3%. For the NASDAQ, your opening bell coming up next.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We were looking at futures up this morning since I arose at 2:30. But we're now looking at a drop of 1/3% here on S&P futures, down even more on the NASDAQ as concern grows about big investors like Peter Thiel getting rid of their Nvidia stakes. You can see Webster Bank here ringing the bell at the New York Stock Exchange, celebrating their 90th anniversary as a bank. The stock has done well over the last 5 years. It's up 71%. So not the S&P, but good for a regional bank. And then Amerisafe ringing the bell, celebrating the 20th anniversary of their listing on NASDAQ. And this stock is only up like 5% over the past 5 years, but I brought it out to 20, breaking my 5-year rule, and they're up 994% over the last 2 decades. So they've done well with that listing. Dani, what are you watching?
I am watching Alphabet shares this morning because they are decisively higher here at the open, 3.8% just about. Warren Buffett's Berkshire Hathaway, they've bought nearly 18 million shares of Alphabet in the third quarter. They've also sold some of their Apple stakes, sold Bank of America, but this puts the stake at about $4.9 billion, Matt.
All right, so an outsized gain on that purchase, but we saw an outsized loss on SoftBank's sale of Nvidia. And Nvidia is taking another hit after Peter Thiel's hedge fund sold its entire holdings in the chip maker. That's just days after the SoftBank story. And I guess one more sign that tech insiders, that Wall Street bigwigs are taking profits at these valuations. We're back with Infrastructure Capital CEO and portfolio manager Jay Hatfield. And Jay, I think this is interesting because yet another sign, right? We've had SoftBank, we've had Thiel now. We have had Michael Burry shorting Nvidia. That big names on Wall Street are starting to point to what they may think is a bubble, or maybe at least say this valuation was good enough to sell.
Well, we're drawing a distinction between fully valued and bubble. You mentioned MicroStrategy. That was in a bubble because that's just trading above its NAV, which is ridiculous. But if you look at the Mag 8, we use a GARP framework, so reasonable peg ratios. Overall, the Mag 8 is roughly fairly valued, 1.5% cheap.
You say Mag 8, so you're adding Broadcom?
Correct, yeah. So everything over $1 trillion, just make it simple. and without value judgments, because I wouldn't call Tesla magnificent, but it's over $1 trillion. But in any case, so it's perfectly reasonable, and we've been doing this. We have much more conservative funds, so actually our funds are doing well in this type of market, but we had small positions in tech because there's a little bit in our index. So we trimmed Broadcom and we trimmed Amazon when they ran up. So it's perfectly reasonable to take profits. But the bubble is not in those companies, it's in the smaller companies. It's in Palantir trading at a 7 peg. So this type of market, or of course, just Bitcoin in general, where you have no actual cash flow, it really disciplines investors and makes them focus on peg ratios, and that benefits us because we always are looking at valuation.
What about the changing nature of these tech giants as it comes to debt? Amazon offering $13 billion in the debt market. Some of the CDS, the credit default swaps, have started to blow out for Oracle CoreWeave. This is Oracle's credit default swaps for 5-year debt has absolutely been widening to an exponential scale. Is a narrative starting to build that something is unsustainable, or at least concerning about the debt load that these tech giants are taking on?
Well, it's important to note that we're after earnings season, and that's when, and so we had actually taken off some exposure because that just always works. It doesn't really show up in the seasonality of November, but it still is operative. So that's when these fears really run rampant because you don't have any information. We will have Nvidia on Wednesday, but we don't believe they're relevant. It is an unusual tech boom because usually tech, you just buy some computers and software and hire some engineers. This one, thankfully, it's one reason we don't have a recession, is very old economy oriented. So even, I came from the utility industry originally, even utilities are benefiting. So it's actually good, but it does require more debt and it takes investors a while to get used to that. But if you look at that blowout, I would think that was like from 50 to 110. So, yeah, I mean, that's
well, blowout for something that's been relatively calm, right? These like debt markets have been insanely calm, and it feels like something is starting to change.
It's also something that Dani has pointed out a lot, which I've been thinking about. After she says it 10 times, then it enters my brain. These companies in the Mag 7 that for the most part have been asset light are buying stuff. A lot more stuff, like hundreds of billions of dollars worth of stuff that is just depreciating. You know, it's like the cars and the motorcycles that I always convince my wife I need to have, and they're worth 20% less the second I drive them off the lot. Isn't that a concern?
Well, certainly it's an uncertainty. I used to audit tech companies and always thought that their assumptions about useful life were overly aggressive. So that's an issue, but we won't know till we know. If you listen to Lisa Su, she used to tell you that there's always use for older chips. So it's a concern, but it is depreciation. So if you look at free cash flow, it wouldn't matter that much. But like I said, we see tremendous demand for AI. Like even if you're on the internet, there's tons of new apps even for retail coming out. But if you're a major corporation and you don't invest in AI, you're going to go out of business. So there's tremendous demand. We're 5 years away from the peak of the bubble. And so when we have these little pullbacks, all these fears come out. And then when earnings come, people calm down. You mentioned private credit, like all the large alternative asset managers reported, they all said there isn't a problem with private credit.
Doesn't, though, that just underline one risk that is emerging, even if it's not a bubble, but the idea that things are becoming more correlated because of the nature of AI? You have more companies investing in AI. Today, it's Levi Strauss. Who knows what sector it will be tomorrow? Caterpillar saying they're now an AI company because all of their growth is coming from AI-related industries. Does that make it more risky? Does that make portfolios just inherently more concentrated if so many of the companies are trying to move into an AI economy?
In 5 years, yes, it could be more big concern because really you have to look at the Fed cycle. We're probably 5 years away from a tightening cycle, and that's when you have the pullbacks and these interrelations kick in. So I wouldn't miss out on 5 years of boom because you're predicting the things that might happen when the Fed tightens and demand goes down and you have these problems emerge.
Jay, we started having you on because you're smart and you had this proprietary research that we and indexes that we think are so fascinating. Then we started to notice that the things you were saying were coming true down the line. Then we realized that the most powerful people in Washington were listening to you as well. But you have products that we never talk about. Like you have ETFs. What are they?
Well, thanks for asking, because I normally get fired as our spokesman because we never mention our ETFs. But we have mostly or all income securities. So we have our biggest fund is preferred stocks, a great asset class, mostly for more conservative investors. And then we have equity funds where we write calls and invest in. ICAP is our biggest equity fund. And so we like these kind of markets because when tech's not doing well, they tend to rotate into our securities. So our funds have been doing well while the rest of the market's been doing poorly. So I would recommend having a diversified portfolio and also look at valuation. So it's great to be in the Mag 8. It's not necessarily good to be in MicroStrategy when it's trading at 2 times its value of Bitcoin. So it's a good discipline for the market. It takes the bubble out of certain parts of the market, and it's good for our funds.
Hey, Jay, such a pleasure to have you on. Thank you so much for joining. Looking forward to the next 5 years of a run-up and looking at it alongside you, Infrastructure Capital CEO Jay Hatfield. Now, check on the stock market right now because you are looking at a NASDAQ 100 that is flipped to positive and an S&P 500 that is just barely inching into being positive, too. It is the strange nature of this market. I mean, just last week, we ended up flat for the S&P. If you were trading every day in this market, it wouldn't have felt like it. It's been so volatile. So what is getting us there this morning? It is Alphabet. Thank you, Berkshire Hathaway and Warren Buffett, for your increased stake in Alphabet. That's moving the shares higher by 5%. The A and B class shares adding 9 and 8 points to this equity market. The Mag 8, as Jay was just talking about, Broadcom, also higher this morning. To the downside, it's Nvidia. Matt's been talking about this. Peter Thiel selling a stake in Nvidia. Apple, you also had Warren Buffett selling some of his shares via Berkshire Hathaway and Apple. Those shares down 1.2%. Looking at how these sectors are shaping up this morning, you have a push-pull in tech that leaves it down just 0.4%. Energy falls, that's down 0.5%. Communication services, this is going to be mostly Alphabet, right? Those shares up 2.6% for that index. So overall, Matt, somehow we've managed to turn things around in the past, what has it been, 10 minutes when the futures were negative. So we are up so far this morning.
Yeah, you know, it's fascinating because last week on the down days, we had breadth to the upside. And today, as we turn higher, we have breadth to the downside.
Yeah.
It'll be interesting to watch what Nvidia does right now, down 1.25%. Obviously, it can move markets, but doesn't necessarily have that result every day at the close. Coming up, the battle for market share in obesity drugs. Novo wants to sell Wegovy and Ozempic at cheaper prices, undercutting Zepbound maker Eli Lilly. But the pricing structure and the timing of these deals is fascinating. We're going to talk about it next with Cynthia Kuhn. She runs our healthcare coverage at Bloomberg News. This is Open Interest.
Let's look at some of the top calls this morning, the analyst action that we are following. First up, Morgan Stanley warns that a memory supercycle could hurt earnings for computer hardware manufacturers. They cut their ratings on HP. Dell gets a double downgrade to sell. Those shares fall nearly 5%. Analysts expect profit margins to drop in 2026, well below what the street is seeing. They also say that PC and server makers like Dell are going to be facing the biggest risk. Next up, Gap gets another upgrade, this time for Barclays to a buy. They say that the retailer's brand recovery outweighs tariff headwinds. They say that Gap's disciplined leadership is driving long-term gains. The analyst there saying that the strategy, sustainability, and brand elevating has been working for the company. Those shares up just 0.4%. Finally, Yum Brands, they get an upgrade at TD Cowen. The analysts say that the likely sale of Pizza Hut could amplify the company's growth by letting it focus on Taco Bell, I guess the crown jewel of Yum Brands. Those shares unchanged this morning, Matt.
Which would you choose if you were forced? I'm saying like 3 a.m. Saturday morning.
Oh my gosh, I guess Taco Bell, because there's more diversity. I don't.
It's the right answer.
Does Pizza Hut sell anything besides greasy pizza? Where's Taco Bell?
At that time that I specified, Taco Bell is the right answer.
Crucial point.
But otherwise, never. Novo Nordisk is undercutting Eli Lilly's prices for certain obesity drugs. Novo will offer Ozempic and Wegovy for $199 a month for the first 2 months of treatment. Then it'll be $350 a month after you titrate up. Bloomberg's Cynthia Coons, who leads our healthcare team on the other side of the building, joins us here on set to explain. So this is really fascinating pricing to me because it undercuts Lilly until you get on it, and you really need to stay on it at that point. But after that, they become one and the same, the price.
Yeah, it's very interesting to see this happening in drug pricing. It's very much a consumer price dynamic, and we don't really see that in healthcare at all. Everything's been so obscure. Everything's been behind the curtain. You see bills, you don't pay them. It's kind of always been a mystery. So this is an interesting step, and it's part of this broader theme we've seen with weight loss drugs. Insurers haven't been covering them in a big way, so these companies are trying to get direct to the consumer. And so doing it in this sort of introductory price way is kind of feeds into this bigger, how do you get people in, get them on your drug? And Novo's been, it's a race against the clock for them. They actually face lower prices in a couple years through the government program, through the IRA legislation sooner than Lilly. So they're really trying to get ahead of it as fast as possible to win share.
But to your point, I mean, this sounds like more like something you'd hear from like the Wall Street Journal, like your first month of the paper is $1 and then it goes up from there. If this was any other drug, I feel like people would be angry about it. This idea that this drug that many people need to have in order to protect their health is going to be cheap the first couple months, and then ramped up significantly.
Well, to be fair, it's kind of how the market's already working, because a lot of people are using telehealth platforms to get the drugs, and telehealth platforms operate in a very consumer-oriented model. And so introductory pricing, I hear you, it sounds very weird for drugs, but in a world where different drugs are interchangeable and many different platforms are selling it, it's now just turned into maybe a more traditional consumer marketplace.
Also, you could argue, and I'm the last person to make this argument.
But you're making it now, go ahead.
That you could just eat right and exercise rather than take the drug,
But for some people, it's genetic reasons why they struggle. I think it's
here
too
with you.
nuanced for that, Matt. It's way too nuanced for that.
Well, also, far be it for Americans to have willpower. Come on. I wonder if the changes that are made in March are going to give Lilly an advantage over Novo, because the Trump administration does seem to want to give Pfizer and Lilly an advantage over foreign drug makers, which makes sense.
Well, I think March is a long time away, and I wouldn't be surprised if Lilly makes a move even sooner, just because they have these vials, they offer prices, and they do cash pay. They have Lilly Direct. So they're doing this already. So I think March just seems like a lifetime away right now, given how fast these price wars are moving. I could see Lilly doing something a little bit sooner. It's really hard to say who wins here, because it's really going to be market share versus price and dynamics playing out over the next year or two until this IRA pricing comes in and really brings it down.
But it's not yet about drug versus drug, right? Because I know that Zepbound apparently allows you to lose more weight, but they both allow you to lose a substantial amount of weight.
I think, yeah, coming from where we've been with weight loss drugs, they're both really powerful drugs and powerful agents, but just keep in mind there's also new things coming and add-ons and drugs that you're going to add to these drugs going forward. So this is still going to be a very high-priced market. I think there's still going to be a lot of attempts by the companies to come out with really expensive alternatives that work even better, have fewer side effects, or preserve more muscle. But in the meantime, I think even in the next couple of months, I could see the continued pricing pressure on both sides.
Yeah, man, it has been fierce between these obesity drug makers. Cynthia, thank you so much for joining us this morning. That's Bloomberg's Cynthia Coons. Now, coming up, diverging tech bets. Berkshire loads up on Alphabet. Peter Thiel's hedge fund dumps its entire stake in Nvidia. We'll have the moves from the latest 13Fs coming up next. You're watching Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check of what's going on in stocks after futures fell, and then we had a positive open, and now we're gaining a 0.25%. NASDAQ up 0.6%. So not hurt by Nvidia shares, which are still down. If you take a look here, Johnson & Johnson's a gainer on an acquisition. Novo Nordisk is unchanged. We were just talking about that story. Tesla is up, even though Peter Thiel reduced some of his Tesla stake. He still holds it. Ford is down, even though they made a deal to sell used cars on Amazon. Nvidia is the important one, down 0.7%. And yet, this market floats higher. Google helping it do that because it's up 6% after Warren Buffett, after Berkshire Hathaway said in the 13F that they do have a big stake there and have boosted it by, what, $5 billion?
Yeah, so the total stake now goes to about $5 billion from Berkshire Hathaway's purchase. Let's get more on that and other tech news. Joining us now is Mandeep Singh of Bloomberg Intelligence. And Mandeep, this comes after Google's already been outperforming. It's up 55% so far this year. That compares with Amazon for 6%, Meta for 4%. What do you just make of the timing of Berkshire Hathaway adding to their Google stake?
I mean, one thing that could have influenced it is the antitrust issue that Google was under, the monopoly lawsuit, and the fact that that overhang was cleared. And that was a catalyst for a lot of the investors in terms of, how Google could have been impacted. Because when you think about Google's assets, it's the Chrome browser, Android operating system, and then the family of apps with over 2 billion users. That's why everyone feels Google will be a beneficiary of AI, that even if the search business gets affected by ChatGPT, they've got all these surfaces where they'll be able to monetize. And I think Chrome was a big part of that.
We've had a wave of bad news on the tech front, starting with Michael Burry saying that he was shorting Nvidia. Then we had SoftBank selling off their entire stake. Okay, maybe because they want to use it for something else that still supports Nvidia. Then we have Peter Thiel getting rid of his entire stake. Okay, maybe he owns competing businesses that he would rather invest in. But there have been a lot of big names getting out of Nvidia. Is it fully valued?
I mean, it always happens ahead of when Nvidia reports. There are always questions posed around how sustainable this is. And look, they've touched $5 trillion in market cap. So clearly, the estimates have gone up. The valuation has expanded. And what I would say to this is our CapEx numbers for next year are probably you're going to see a 40 to 50% increase from the big hyperscalers. And all of them are customers of Nvidia. The one big caveat here is Google is looking to commercialize their TPUs and sell to someone like Anthropic, which has said they want to spend up to $50 billion. Not like the OpenAI number of $1 trillion plus, but still, $50 billion is sizable. And if Google is able to commercialize their TPUs, then that will have some sort of an impact on Nvidia. But look, I mean, all these investors, whether it's Peter Thiel or someone like that, they are anticipating, what will happen to Nvidia 2 years from now. And so they're not trying to time the exit perfectly. It's more about, yes, we know probably they're not going to go triple digits anymore. It's still going to be very healthy growth, and maybe that's how they're sizing their position.
Yeah, to be fair, Jay Hatfield was like, it'll be a problem in, 5 years, but now it's great. What do you make of more of these tech giants, so that CapEx coming from debt markets? Amazon today, $12 billion for its first U.S. bond sale in 3 years. Alphabet, $25 billion earlier this month. Meta, $30 billion last month. Oracle, $18 billion in September. What do you do with that, Andy?
Well, I mean, look, these companies have the credit rating profile to raise money in the bond market. And still, they're going to be investment grade and above. So from that perspective, given the insatiable demand for building AI data centers and infrastructure, I think it's wise for them to tap the debt markets, given everyone wants a piece of this. And so from that perspective, I don't see any red flags. Look, they are still generating up to $100 billion in free cash flow in most cases. So they clearly can fund a portion of it. And if some of it can be off balance sheet, that's a good thing.
All right, Mandeep, great having you on as usual. Mandeep Singh runs our technology coverage at Bloomberg Intelligence, now on the 10th floor. Coming up in the next hour, Kim Forrest of Bokeh Capital discusses the AI bubble debate with us. KKR's Chris Sheldon talks about private credit and a risk to markets. Plus, Stagwell's CEO talks about the company's new partnership with Palantir. We are 30 minutes into this Trading Monday. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. The tech fears not having a big impact on markets this morning, turning around in this equity trading session.
And we have had some big names diverge on Tech. Peter Thiel bails on Nvidia, but Warren Buffett's Berkshire Hathaway puts billions into Google.
And awash in garbage lending. That's the latest word from Jeffrey Gundlach, who is warning that private credit is the next subprime.
Plus, the Swiss Miss, UBS, may ditch Switzerland as its chairman mulls a move to the United States of America. But we begin with the AI bubble debate ahead of Nvidia earnings coming out on Wednesday. Jay Hatfield of Infrastructure Capital Management weighed in.
We see tremendous demand for AI. Like, even if you're on the internet, there's tons of new apps even for retail coming out. But if you're a major corporation and you don't invest in AI, you're going to go out of business. So there's tremendous demand. We're 5 years away from the peak of the bubble.
Joining us now is Kim Forrest, Bokeh Capital Partners founder and chief investment officer. And Kim, it strikes me that you could easily have said the same thing about the internet in 1999 or 2000 or 2001 or 2002. And yet, after that crash, it took years for valuations to get back to where they were at the top of the bubble. What do you think about AI?
I largely agree with what this fellow is saying. That AI is real, that companies should explore how to best use it. And it's interesting, but to me, almost irrelevant that people are building apps that use AI. Of course they are. It's the latest buzzword that every consumer thinks they want. My note of caution is this. The thing that most consumers and even investors think of AI is the large language models like Anthropic and OpenAI and all of that. And I'm giving you a warning here. This is free, so take it for what it's worth, that there are fundamental issues in these models that make the error rates really high when you're trying to do perfect work like we do in corporate America, or as close to perfect as we can, that are not being solved. And throwing more money at it through the building of unbelievable amounts of computing power is not going to solve it. It really is that easy. So while I believe in AI, this current incarnation is dangerous for investors.
We should also point out that also, not only is she a chief investment officer, but she has a history in software engineering. So Kim speaks to us from a place of intelligence when it comes to what you can and can't do with these models.
Well, Kim, doesn't that also speak to this idea, considering just with how tied the market has started to be to AI and how big these giants are? Kim, does that mean that unless you are a specialist, unless you have that sort of software engineering background, that it gets hard to fully analyze and understand the true value in some of these companies?
I think you're exactly right. And it really was the matter. It's the same thing that happened in bubbles before, is that there's people that are going, please, think about what you're doing. And then you just get swept along because you see the promise, or, there is a promise in AI. There absolutely is. But I'm more of the Palantir, smaller models, that sort of AI, rather than this big brain that we all somehow access. And I think that it's really difficult to swim against the stream. And that's what we're asking investors to maybe consider. And people like Peter Thiel can afford to. But maybe you're somebody else that you don't feel like you can afford to swim against that stream. And it's a tough position to be in.
So where do you invest, Kim, in, given that you agree, and I think everyone else does, that AI has a future and a definite use case, but that the spending of these big companies is a little too aggressive, that maybe Mark Zuckerberg is wrong about only misallocating a couple $100 billion in order to, do the real spend that they need. How do you invest around that?
Well, I carefully. That's the funny, glib answer, but that's also the truth.
Especially since you named Palantir, by the way, as an example of someone who's doing it right, but also is trading at exponentially higher multiples than a company like Nvidia.
And I'm not recommending Palantir. I just said that they're modeling how they're using AI is kind of my way of using AI, and that's where I think productivity comes in. Is you have a problem. You solve it using AI, which is really good at two things, optimization and pattern matching. So if you have a problem that has those two things at its heart, AI might be for that problem. And well, I guess the easy answer to your big question is don't overweight this area. And as hard as that is for investors, because this is where the action is, do yourself a favor and, buy stocks that aren't related to necessarily to AI, but are still good companies. I think that's the best advice I could give to anyone. But I think so many people are piling on in so many ways. For example, I get lots of questions from investors that are saying, well, how about electric component manufacturers? Because we're going to have a lot more electricity. And how about like all of the other things that go into building data centers out of nothing, out of farm fields? And I'd say beware of those areas, because it's unclear that that is going to solve our problem and that all these planned AI data centers are needed. That's the big issue right now.
Kim, isn't it, though, getting harder to find those areas that aren't connected to AI or at least aren't impacted? I think, for example, about manufacturing capacity in the U.S. There was a great story written by our team last month on this idea that so many of the capital that's going towards manufacturing is going towards AI. Is there a real crowding out in this overall economy, in the way corporates are spending, that all that money is going towards AI and other things are getting ignored?
Well, I think it's going to do that for a while. But unlike Microsoft, Meta, and Google that have businesses that create unbelievable amounts of cash, most companies aren't in that luxury area. So a company, I don't know, that makes soft drinks, think about that. Maybe look at that. I know it's ridiculous. I'm a tech person. I was a software engineer in a neural networking, which is the foundation of AI, company, a couple of them. And I'm telling you, look in other areas. There are quality companies that are spending on AI, but aren't betting the farm. And maybe that's where you should look.
Kim, very sound words this morning as those warnings pile up. Kim Forrest at Bokeh Capital Partners, thank you so much for joining us. A quick check on markets this morning. The S&P 500 now unchanged, some real chop this morning. NASDAQ 100, that stays positive, up 1/3% with the bond market, little change. It has been under pressure from that $13 billion offering from Amazon, so stocks just staying afloat this morning, Matt.
Let's take a look at some of the single stock stories. Half hour into the session, Google is surging after Warren Buffett's Berkshire Hathaway bought nearly 18 million shares of Alphabet, the parent company, in the third quarter. And as a result, Alphabet's up 5%.
We've also been following Nvidia this morning. It has been taking a hit, down 1.6%. There's a 13F filing that showed Peter Thiel's hedge fund sold off its entire stake in the company last quarter, something Kim was just talking about.
And Ford struck a deal with Amazon to sell its used cars online through Amazon's autos portal. Ford itself is down 1%, but if you look at some of the other used car dealers, like Carvana, for example, they're also seeing movement, but to the upside. Carvana gaining 2.7% this morning.
Of course, why not? All right, coming up on the show, Christopher Sheldon of KKR talks about how the firm is differentiating itself in the credit markets as Jeffrey Gundlach warns of garbage lending. And happening right now is the Bloomberg Africa Business Summit, where business leaders are speaking ahead of the G20 summit in South Africa. You can catch that by watching live go on your terminal. Bloomberg's highlights for tomorrow include JP Morgan Vice Chairman Daniel Pinto and the Johannesburg Stock Exchange CEO. This is Bloomberg.
Now to high interest and look at what's happening around the world. President Trump is urging House Republicans to release the Justice Department's Epstein files, reversing his months-long stance against it and confirming that Pam Bondi was wrong when she said they didn't exist. On social media, President Trump said, "We have nothing to hide. It's time to move on." The House is expected to vote this week on whether or not to make the Epstein files public. Amazon is joining the AI bond boom, selling about $12 billion in debt It's the tech giant's first U.S. dollar sale in 3 years. The cash will help fund data centers, chips, and AI investments as rivals also race to expand their computing power. Goldman Sachs, J.P. Morgan, and Morgan Stanley are leading that sale. And new research shows a handful of investment consultants helped drive the massive shift of U.S. pension money into private markets, steering trillions of dollars into private equity, real estate, and hedge funds. Harvard and Stanford researchers say pensions followed the advisor's playbook, tripling their exposure to alternatives, and with it, the risk of costly mistakes.
Now, speaking of alternative investments, DoubleLine Capital founder Jeff Gundlach has a warning. The next big crisis in financial markets will come from private credit. He spoke with Odd Lots anchor Joe Weisenthal and Tracy Alloway.
The most ridiculous argument of all for private credit has been private credit belongs in every portfolio because it lets you sleep at night, because it helps you ride out the volatility of your public credit. Again, that's just a repackaging of the volatility. If you don't market to market, there's no volatility. But if the price goes from 100 to 0 in a matter of a few weeks, there's something untoward is going on. And so I'm very, very negative on those types of non-transparent markets. It reminds me, I've been saying this for probably 2 years now, that the next big crisis in the financial markets is going to be private credit. It has the same trappings as subprime mortgage repackaging had back in 2006. Now, it took a couple of years for it to totally unravel. So this stuff doesn't happen in a week or a year even. But I'm very negative on that.
DoubleLine Capital founder Jeffrey Gundlach speaking with Odd Lots hosts Joe Weisenthal and Tracy Alloway. For more on the state of private credit, we're joined by Christopher Sheldon, KKR co-head of credit and markets, who joins us now. Chris, there's a lot we want to talk with you about, but we have to just start with Gundlach's comments, given how much interest that they're starting to take. And we want to talk to you not just because, of course, you oversee KKR's credit portfolio, but you do a lot of research on the state of the industry as a whole. In the words of Gundlach, is there a concern that there's, quote, garbage lending going on out there?
We just don't see it. I mean, if you look across our corporate credit, private credit portfolio, our revenues are up 9%, our EBITDA is up 8%, our interest coverages are healthy over 2 times, our average LTVs are sort of sub 60%, so we're just not seeing that elevated concern. However, we are seeing slowing in the economy, and we are seeing more dispersion in results. We see that in the public markets, we see it in the private credit markets, but we're not seeing that level of concern that Jeffrey mentioned.
It seems like we haven't really seen a million cockroaches, right? You've seen a couple of really idiosyncratic issues, and it's hard to argue otherwise. The problem isn't that there are occasional bankruptcies here and there. It's that BlackRock marked this debt at 100%, and then 2 weeks later at 0, even though they knew from months beforehand that there had been negotiations about a revamp here. It's the marks that are the real problem in these issues. And do you think that the industry needs to look inward and figure out a better way of doing that?
Look, I mean, I think we use a third-party valuation to evaluate all our illiquid assets. And I think where you're seeing dispersion in the valuations are when assets underperform. And so I think it's really just about a policy to make sure that you're working closely with those independent valuation providers to make sure you're giving the real up-to-date information of what's going on in an individual credit. How others are doing it and the velocity of the moves is depending on each situation. And you are seeing, to your point, very idiosyncratic situations that sometimes move extremely quickly in terms of if they're hitting a liquidity wall to where maybe there is a little bit more aggressive in quickness of moving that mark.
Chris, it's interesting you talk about the divergence, because maybe the kind of dirty little not so secret of this industry is that private credit returns don't look that different from player to player unless you do something that really gets messed up. So in a world where you also have more money coming into the asset class, where you have rates coming down, How difficult is it to find alpha right now in private credit?
Yeah, and private credit is defined, depending who you talk to, it's defined in many different ways. And you're right, there hasn't been a lot of dispersion in corporate direct lending returns manager to manager, although I expect more and more dispersion to happen. And so what we're really doing across our corporate direct lending book is running very diversified portfolios, keeping it very high quality at the upper end of the middle market. And I think that's where you should be playing, is not reaching for that incremental yield, incremental few basis points, which often leads to risk. I think where dispersion in returns will happen is when you make more concentrated bets or you're reaching for incremental risk. Where we see alpha is actually trying to be as flexible as you can be, find those pockets where there isn't as much supply and demand imbalance, and those areas could be things like capital solutions or asset-based finance, where that supply and demand imbalance is not as pronounced, or in regions like Asia. And then where there's areas where there's a little bit more exuberance, where there's been a lot of capital coming in, like the liquid markets, like corporate direct lending, keep it high quality and diversified. And it's hard to lose money if you do that, keep to your knitting, and from a credit underwriting, if you're earning high single digits in income, you have to make a lot of mistakes with very severe recoveries to actually not ink out positive returns. Which goes to my point, is where we're just not seeing the concern that maybe others are.
One of the, I think, really cool ways that you can differentiate yourselves is through your experience as a private equity company for so many decades with portfolio companies and leading strategies that are successful. So I've noticed you have worked with companies like Harley-Davidson, which could obviously tap the plain vanilla syndicated loans market, but do they choose to work with you because they also want your advice and your guidance on how to improve their businesses?
Yeah, there's a couple trends going on where corporates are tapping into private markets and large public companies are tapping into private markets. And I think historically that was perceived as a weakness. They didn't have access to other capital. Now they're actually looking for partnership capital. Either they want us in the boardroom and want some help with something that maybe they don't have the skill set for, or there's this big trend where if you've been a capital light model, your stock has been up and to the right, and if you've been capital intensive, your stock's been relatively flat. And so there's a big push to finance stuff off balance sheet, which is similar to what we did with Harley-Davidson, what we announced with Sallie Mae, what we've done with PayPal, where we're taking a bunch of assets, taking it off balance sheet, finance those. That gives them capital to future their growth initiatives and turbo that a little bit quicker.
And you could probably add Keurig Dr. Pepper to that list too, which of course you were also part of that deal, Chris. And to
Correct.
The point that both you and Matt are making, I mean, these are deals that it wouldn't be unusual to usually see them in the broadly syndicate market. And maybe that's why someone like a Jamie Dimon hasn't loved you and your peers, because it's taking away market share. How do you see that balance continuing to evolve? Is this an industry that you think will continue to chip away at the market share that banks usually hold in lending?
Look, we need banks. Banks need us. It's a cohesive relationship, and a bank is usually involved in many of these large transactions from an advising standpoint. And look, the banks are some of the biggest financing providers for our diversified portfolios against private credit. So I don't see it as an either or. I see it as a partnership that's getting stronger. And I do think that the larger you are, the more scaled business you can do, the more diversified the type of businesses you can do, that's where you're going to have bigger, better, and stronger partnerships with the banks.
Chris, great to get some time with you. Really appreciate it. Christopher Sheldon there of KKR talking to us about private credit. Still ahead, how AI is changing marketing. Stagwell chairman and CEO Mark Penn joins us to talk about the company's partnership with one of the companies that Kim Forrest was saying she thinks is doing it right, and that is Palantir. More from Mark Penn next. This is Open Interest. Taking a look at the S&P right now. This is the move screen. I think it's the most dynamic way to look at an index. Right now you can see we're only off by 2 points on the S&P 500, so half a tenth here, and the breadth is to the downside. 285 stocks falling, 217 rising. The important aspect of this is which are doing the movement. So on the plus side of the ledger, we have Google moving up almost 5%, and it's a fairly heavy company, right? It's a $3.4 trillion company right now. On the other hand, Nvidia, which is just under $5 trillion, is falling, but not by nearly as much, 1.7%. So the two are kind of evening each other out. If you take a look at the breakdown on an industry group level, you can see that we're pretty evenly split there as well. Communication services, that's Google, to the upside, as well as utilities and healthcare. On the downside is IT stocks. That's Nvidia, as well as energy and consumer discretionary. So you really have to take a look under the hood, Dani, to see the individual movement in the indexes, as at the broader level, there isn't much.
Well, I'm also wondering if dip buying is actually working. I mean, stocks aren't down, but they certainly aren't significantly higher. Lori Calvasine of RBC saying that the retail trader is starting to run out of some steam. Okay, coming up on the show, Stagwell has announced a deal with Palantir. The idea, they will be creating an AI-driven marketing platform. We're going to be speaking to Mark Penn, the man behind the deal, Stagwell chairman and CEO. That's coming up next.
Marketing firm Stagwell has partnered with Palantir to create an AI-driven marketing platform, and Stagwell says the partnership is already seeing client adoption. Joining us now to talk more about it is Mark Penn, the chairman and CEO at Stagwell. And Mark, I'm glad to get you on. When I saw this announcement, I immediately said we have to hear more about this story. And we were just talking with a software engineer turned Wall Street analyst who said Palantir is one of the companies that's doing it right. How do you use their intelligence in your business?
Well, we're combining the incredible data ingestion and AI capabilities of Palantir with our engineering team out of the Code and Theory Network and centrally that really has the marketing know-how. And together, we're aiming to create what I call the holy grail of marketing. That's where you sit back when you're in a big company and you say, give me all those people who might need back to school. Well, tell me what back to school things they might really need. Let's take them within 10 miles of our store. Let's maybe then look at the lookalikes within 10 miles who might need back to school. Let's execute the back to school campaign. That kind of marketing that can only be done in the AI era with incredible work from Palantir in terms of data ingestion and AI, and our real marketing know-how in terms of how marketing works and how you can interpret the data.
Well, if you look at these campaigns, Mark, from strategy to execution to reporting, on that supply chain, just thinking about how quickly it's being adopted, how much of that do you think can eventually be replaced by AI?
Well, AI is never going to replace what I call the team on the bridge of Star Trek, okay? The people who have to make the decisions and set the strategies, do the high-level creative. AI really comes in as technologies usually do, and they reimagine kind of the mid-level, right? And so they make things fundamentally more efficient. But people don't realize that cheaper marketing means that actually companies will market more. That the cost of marketing is an inhibitor to doing marketing because when you reach the ROI of break even, you stop. And if you push that back through greater efficiency, companies will actually do more rather than less marketing.
You have, I imagine, also tools that help companies do this, right? It's not only about aiming the advertisement or the message at your target audience, but also about crafting that message and then putting it into content form, be it video, audio, or what have you. How do you deliver that to the client?
Right, so we're about 12,000 people in 51 countries, 2.5 to 3 billion in revenue. And so we believe in the right combination of human creativity and technology. And so people put together the uber ideas that really, I think, are incredibly essential We work for, obviously Fortune 1000 clients around the world. And then, but technology now really kind of can spin out, the content level in terms of we've got a partnership with Adobe, and then the targeting level in the partnership with Palantir, and then deliver and then analyze those campaigns. So you have to think of marketing now as a totally different process from what it was. Right? It used to be you make an ad and you put it on the Super Bowl. Well, we still make ads and put them on the Super Bowl, but that's maybe 5% of the marketing ecosphere here. And this dynamic new marketing ecosphere is exactly what Stagwell was built to handle.
Mark, but to your point, as you said earlier, some of the costs of advertising are coming down with the use of some of these tools. Are we entering into a future where there's just more noise out there, where there's more AI-generated content that maybe doesn't have the story capabilities of the humans over at Stagwell that you are now going to need to fight through?
Well, look, I think, first of all, what I always say about technology is don't look at the old stuff that technology makes easier. Look at the new stuff that you really couldn't do before technology came along. So yes, there's going to be a lot of junk AI content out there. But yes, there's going to be higher level content that could never be created before, sort of like when Star Wars broke onto the movie scene. And that's what's going to create more interesting, more engaging marketing. I mean, look, an average person sees 2,000 ads a day, right? They only notice maybe 5 or 6 of those ads. Look at how much is wasted that we're going to make more effective with AI. So yes, some of AI will, I think, create a lot of junk, but the other part of AI will create, sublimely more perfect advertising and marketing than we've ever had before.
I wonder what you think, Mark, because it's interesting with your career, with your experience as a pollster and in politics, but also you were doing like neuro polling before we were interested in neural networks, right? What do you think of the adoption of AI by people and corporations versus the investment in AI in hundreds of billions or trillions of dollars?
Well, look, I've been around technology for a long time. I started my company building computers and kits and programming an assembler, right, to have the fastest overnight polling that any private company ever had. So, and then I was chief strategy officer at Microsoft, as well as in charge of all their advertising. So I have what you call a pretty extensive background now in technology, and AI is the most powerful, important, let's call it invention or creation, since probably the internet itself. And I think that this investment is fully justified, that AI is real, it's not the metaverse, it's not, it's not tokens, it is a genuine kind of leap in terms of what's capable and what we can do with computers and how humans can interact with computers to achieve their goals. It is I believe in the investment. I believe that these companies should not and will not pull back from it.
Well, Mark, Matt mentioned your extensive background that includes in politics, and maybe significant then that Axios has been reporting on a new public affairs firm that you're launching. Your president saying it's a polarized environment and corporations can't win from the top down. Given that polarization, given the use of AI and the changing of technology, how much more difficult is it to shape and get out and convince with a political message right now?
Well, look, we have a risk and reputation group that helps corporations kind of manage, the political world. Political messages used to be primarily driven on TV. Now you can see that they're being driven at least equally on social. We have an active advocacy practice as well in the company. It comes online every other year. We raise close to $1 billion of online kind of fundraising money. We believe that politics continues to be a growth area. It's not just an on-off, but it seems to get bigger. And the fact that the country is basically 50-50 means that you will hit record amounts of communications and money being spent on politics, particularly in those very small competitive districts.
And turnout, right, Mark? I mean, at presidential elections, we'll continue to have record turnout at votes.
I think turnout will continue to increase. People don't realize that there's 90 million people who are registered but don't turn out. So you'll have more turnout, you'll have more involvement, you'll have more advertising. But turnout is really very high in the truly contested areas. But it is going to be another record political season. It will affect the entire media industry. It will affect all platforms, and it will also lift the boats at Stagwell.
Hey, Mark, this has been so smart. We're going to let you go. It sounds like there's a dog in your vicinity that might want to go outside, so we'll let you go. Mark, thank you so much for joining us. Please come join again soon. Mark Penn of Stagwell. All right, a check on markets this morning, more than an hour into your trading day, and we've turned negative now for both the S&P and NASDAQ. I mean, negative, it's barely changed for the NASDAQ 100. We just barely had a gain last week. There's been some serious chop to this market, and it continues this morning. 10-year yields also down by 1.9 basis points. They are trading at 412.89, Matt.
All right, let's get a look at some of the single stock stories at this hour. Novo Nordisk is undercutting Eli Lilly on obesity drug pricing for cash pay patients as it tries to claw back a larger share of the U.S. market. As a result, Novo Nordisk shares are inching higher, and Eli Lilly shares are down just 2/3 of 1%.
Meanwhile, in other pharma news, Johnson & Johnson, they are buying Halda Therapeutics $3 billion in cash. They are hoping to bolster its offering to treat prostate cancer. Those shares up by 1.5%.
And Dell and HP are down after Morgan Stanley cut the stocks due to risks from a memory supercycle.
Coming up on the show, SoftBank dumps Nvidia, and Peter Thiel's hedge fund did the same thing last quarter. We're going to have more on the latest 13Fs, what they say about the stock, all of that coming up. This is Bloomberg Open Interest. Tech companies powered the latest round of 13F filings. Bloomberg analysis showed that tech stocks account for 26% of hedge fund portfolios. The next closest sector is consumer discretionary, accounting for 16% of holdings. For more takeaways from the filing, Bloomberg hedge fund reporter Hema Parmar joins us for more. Hema, I mean, not surprising that people were so into tech. Maybe the more surprising thing is someone like Peter Thiel being very selective in selling off some very popular tech holdings.
Yes, he has a very concentrated portfolio, just a few positions, and he sold off his entire stake of Nvidia. It was worth about $100 million at the end of the third quarter. Now, it's not that much when you look at hedge funds broadly and how much money they have in some of these stocks, but it's notable because he ditched it entirely. Amid a lot of these concerns we've seen over AI valuations, the money that's being pushed into this space, and concerns about the risk that lies ahead.
Right, the SoftBank sale, the Michael Burry short. Yeah. If you look across 13Fs, and I hope you have like a chat bot that does that for you.
Yes.
Is Nvidia a buy or a sell or neutral?
It's really interesting because we looked at over 900 hedge fund filings, about 160 split. 160 people increased their stake in Nvidia, and about 160 funds decreased. Oh. So it's very close, 161, 160. It's so close. So you can really see that the market, it does appear to be quite split on what lies ahead for this really interesting company.
I'd say something makes me kind of sad that Michael Burry is closing his hedge fund, because that used to be one of the fun things at 13Fs too, to see what he's buying and selling.
Yes.
We still have Berkshire Hathaway though.
We do.
That tends to be the one that moves markets. It's that Alphabet holding that seems to really have captured the market's attention this morning.
100%. He bought a sizable stake in Alphabet. Now, this is a position that could be worth more than $5 billion. It's still his 10th biggest holding, even for such a large purchase. It shows you just how much money he's putting to work these days, and it's a brand new stake for him. And if we look at something that he decreased, he cut his Apple exposure by about 15%. Now, the stock is still its biggest holding. It still accounts for about a quarter of his total portfolio. So it may have been more of a rotation to protect the portfolio construction than necessarily a directional bet, but Alphabet, clearly a directional bet.
One of the cool things we've heard about Michael Burry, or that Dani has been talking about, is that he did this before the big short as well. Like at some point he needed to get rid of all the client pressure and just go all in on the big short, and maybe that's happening again.
It could be. It's a really interesting time when you look at these tech funds and what they're pushing into and out of. We saw Tiger Global cutting its stake in Meta by 63%. That is a huge move for a fund like that.
All right. Hema, thank you very much. Hope we get you back soon. Hema Parmar covers hedge funds for us on the other side of the building and sits right near Sri Natarajan, who is our Wall Street correspondent, here again to talk to us about UBS potentially holding private talks with the Treasury Secretary, Scott Bessent, about moving its headquarters. And yet somehow these private talks got leaked to the FT. And now, I mean, Switzerland better worry. Like, if they do the wrong things, Union Bank of Switzerland is going to leave, right?
Well, that's the threat at the heart of this, right? Yeah. We've been hearing about this. We've been talking about this for the better part of the last year because UBS executives have been more open. Even in public forums, they have been talking about how extreme these new capital rules can be, how punitive it will be for UBS. And they are very clear, the topmost executives, CEO Sergio Armati, Chair Colm Kelleher, that their first responsibility is not to expand and embed the legacy and lore of the 163-year-old Swiss bank. Their first priority, they say, their fiduciary is to their shareholders, their investors, and if their capital requirements go up, where they have to set aside another extra $26 billion to meet these demands, that just does not make sense for them, and they would be willing to consider other options. Not option number one, it's not the desired outcome, but they want to make clear to the folks on the other side of the negotiating table that it is certainly on the table.
Say, isn't this like a win-win for UBS? Either Switzerland lowers those capital requirements or they go to the US. I mean, would it be such a bad thing for them if they did come over here, if they did switch their headquarters to America?
Have you not been to Switzerland?
Okay, maybe not for the bankers, it's not a good thing.
It's amazing.
Okay, put that aside of, you know, what it means for your personal taxes for the bankers and ability to go skiing in the Alps. What about for the business itself?
Look, I know Matt's talking about it from the tax rate perspective, but you cannot discount the fact that it would be a seismic move. Again, UBS is very much embedded with the identity of Switzerland. It's been around since 1862. The expansion and the creation of modern-day Switzerland is thanks in part to the financing provided by their giant banks like UBS and CS, Credit Suisse, which is now within UBS as we know it. So it is not going to be an easy decision. There will be a lot of back and forth on this. This is not something that can happen easily. And yes, you do point out that there is a scenario where if they talk about this long enough and loudly enough that the Swiss government will finally back down, that is not a given. We've had this play out over the last 9 months, and we've not seen the posture on the Swiss side, on the government side, to water down these rules. The final rules are going to be voted on in 2027, so we're still a bit away. So yes, UBS might be trying to anchor the negotiation, and things might work out in their favor. There might be some watering down, but it is not a given that the Swiss government will cave in this scenario.
UBS, I know, is a behemoth, especially after folding in Credit Suisse, but how does it stack up against the big banks that are already here in the U.S., you know, a J.P. Morgan, a Goldman Sachs, a Citi?
So what is UBS today? UBS has this big national Swiss bank that is important in that score, and that's critical to Switzerland. But beyond that, it has this global wealth management operation. It has a U.S. investment bank and an asset management business. So yes, we're talking about headquarter relocation, but as UBS has been in this tussle with Swiss government and the Swiss regulators, its rivals and peers in the U.S. have also been talking up the idea that perhaps if UBS has to consider some dramatic options, there might be players who might be willing to buy, say, the UBS wealth management platform in the Americas. The investment bank does not punch at the same level as some of the biggest U.S. investment banks. So does it make sense for UBS to stick to it? So there are some other options that could still be considered before a complete relocation of the bank to the United States.
And skiing in the Rockies is pretty cool, too. So
skiing in the Rockies is great.
Yes.
You know, but I mean, the whole life in the Alps is, I feel like, on another level.
You know? I'm sure a lot of UBS bankers would agree with you, too.
St. Anton, Kitzbühel, Lech Source, you know.
Thank you for joining us. We won't get into the skiing debate. That's Bloomberg Chief Wall Street Correspondent Sri Natarajan. Okay, coming up, the reason behind former Fed Governor Adriana Kugler's abrupt resignation in August. We have those details on a recently released ethics report. That's coming up next. This is Bloomberg Open Interest.
All right, former Fed Governor Adriana Kugler violated Fed ethics rules and was subject to an internal investigation when she resigned back in August. This according to documents released over the weekend. Bloomberg U.S. economy reporter Enda Curran joins us now from Washington. So, Enda, first, what did she do? What did her husband do? And why, having just seen the same kind of scandal push out other Fed leaders?
Well, we now know, we're getting some details on this via my colleague Mara Mukwe, that former Governor Kugler, she violated the Fed's internal ethics rules. It does revolve or centre around trading of financial securities undisclosed and during periods when they shouldn't have been, during the blackout period. For example, the governor was and is subject to an internal probe at the Fed. She had sought a waiver from Fed Chair Jerome Powell. If that wasn't granted, and after skipping that July policy meeting, she later announced her own resignation from the board. Now, to your point, former Governor Kugler was in the headlines for a similar issue before, so it's the second time around here. And of course, her departure was quite consequential for the Fed because when she left, it gave an opportunity for President Trump to appoint somebody to fill that opening on the board. And he appointed, of course, his economic ally, Stephen Meyer, to that position. So it's been quite an important story for the Fed all around.
And to Matt's point, though, it just adds to the names that have experienced these trading issues that have caused them to step down. Kaplan, Rosengren, not all of them said they were leaving because of it, but they were all under investigation. And this gives ammo to the critiques of the Fed that something needs to change, the fact that this can happen again. What sort of controls are there in the Fed? And is there a real discussion about making sure these ethics violations or questions don't come forward again?
It does. I mean, the Fed did institute rules that were designed to safeguard against these kind of violations in response to those earlier incidents that you mentioned there, Dani. But clearly, there's no doubt about it that both objectively and, of course, if you're looking for a stick to beat the Fed with, it's clearly not a good look. I mean, the optics of these officials being called afoul of these internal ethics rules during a time, of course, of acute political scrutiny and pressure on the Federal Reserve. It's neither a good look for the Fed, and nor does it help the Fed itself. And of course, remember, there's also the broader debate happening right now among plenty of Fed skeptics in terms of the Fed's own policy decisions over the past few years, the inflation story, the SVB banking regulation story. Now you throw in sort of the internal ethics story and failures around corporate governance idea, and there's plenty of ammunition piling up against the Fed at a very sensitive time when the president has the window to choose that new Fed chair over the coming months for when Chair Jerome Powell steps down next May. So yes, the Fed had instituted rules to deal with this, but we've just had another example of it, and certainly to your point, Dani, it would only add to those critics of the Fed who are looking for every opportunity to step in right now.
All right, Enda, thank you very much. That is Bloomberg's Enda Curran. And as we get to near the end of the hour, a quick check on markets that are going a whole lot of nowhere. Even some of the bearishness on tech. You do have the likes of Mike Wilson from Morgan Stanley. Matt, his price target for year-end 2026, 7,800 on the S&P.
Yeah, we do have still a lot of bulls in this market, but it's interesting the bearish signals that seem to be piling up. Tomorrow we have Gargi Chowdhury of BlackRock, Anastasia Amoroso of Partners Group, and Rachel Arnold of Vista. This is Bloomberg.